traders, it's Todd Gordon, tradinganalysis.com. Those of you who don't know me, you've probably seen me around on CNBC quite a bit. I was actually the in-house technical analyst on the show Money in Motion. That was on for 2 years, and I've done many guest appearances and been around the trading markets for a long period of time. So in tonight's video, I want to talk to you about a preferred style of analysis and how we set up trades for our clients. We have clients in over 40 countries around the world. We focus on the currency markets, the fixed income markets, the equity markets, as well as the commodity markets. And the methodology I want to talk to you about tonight, and I want to apply it to what's the market that's moving right now quite a bit, which is actually the S&P 500. Okay, so what we're talking about tonight is the Elliott Wave Theory. All right, now there's a lot of misconceptions out there in the market about what exactly Elliott is, and is it too subjective, and is it too difficult? To put it to you straight, is it difficult? Yeah, it's a little bit. But I'll tell you what, anything that is worth it and that will stand the test of time probably takes some work. I hope you're willing to do the work. Work is fun, especially when you get to do this for a living. It's a lot of fun. So don't discount it because it's a lot of hard work. Number two, you might hear that it's a very subjective way of looking at the markets. To a point, I agree. And as you progress with us, you'll actually find out that that subjectivity is a positive. It helps you structure favorable risk-reward trade scenarios, okay? The way we apply Elliott Wave is to trade the market, not forecast the market. And as you grow as a trader, you're going to figure out that there's a big difference between forecasting the market and trading the market. I've been trading the markets for a long period of time. I've traded for a hedge fund. I've been on Wall Street. I've been an analyst. I've been a Wall Street analyst. I've been a prop trader in San Diego, lived on the beaches. I've been trading in my 35 years. I've been trading for over half of my career, which it's not a great period of time, but I have learned that there is a big difference between trading and forecasting. If you're trying to use the Elliott Wave Theory to forecast where prices are going to be with a high degree of certainty, a year, 2, 5, 10 years from now, I think you're going to have a really hard time, okay? Because I'll tell you what, there's no methodology out there that's going to allow you to forecast with a high degree of success where the markets are going to be 1, 2, 5, 10 years from now. What Elliott Wave does is it helps the trader immensely, okay? What we do is identify key value points in the market, doesn't matter what market we're looking at, to structure low-risk, high-reward trading scenarios. And a lot of times, we go into a trade with multiple wave counts, okay? There's the subjectivity. But the good news is that those multiple wave counts all point to the market going in the same direction, okay? So Elliott Wave is incredibly useful to the trader, okay? And in today's market, good luck investing, especially with what the S&P is doing, starting to roll over from a long-run investment time frame. I don't think we're going to see the kind of run we've seen since 2008 up to where we are now, 2009 to where we are now. So if you're a trader, you're an investor, I think you need some kind of methodology that's going to help you learn to identify where the market is going to find support, where it's going to find resistance, and then structure low-risk, high-reward trades. So don't take my word for it. Okay, here's a book that all of you should have read. If you hope to make it in this game, you need to have read this book, Market Wizards, Jack Schwager. Okay, 3/4 of you out there have probably already read it. And I want to draw your attention to the chapter on my personal hero, Paul Tudor Jones. Okay, back cover right here. He says, Tudor Jones, whose funds have registered triple-digit gains 5 years in a row. Okay, he's also the head of the Robin Hood Foundation, which has generated billions for charity. Okay. And the page I want to draw your attention to, 130, is the reason you've been so successful is the Elliott Wave Theory allows one to create incredibly favorable risk-reward opportunities. Okay, that's the same reason I attribute a lot of my own success to the Elliott Wave approach. That's Paul Tudor Jones and Market Wizards. Okay, so trust me when I say Elliott Wave is incredibly useful for today's trader and even investor. So what I want to do is take the Elliott Wave Theory and apply it to the S&P 500 today. And I think you'd be pretty interested to see what we come up with. Okay, traders, so here we go. We're looking at the S&P 500. And as you know, markets are very wound up. Volatility is very pumped up. Fear is high. People are thinking that this is an absolute top. Okay, this is a time where you got to set yourself aside from the crowd and think to yourself, okay, I need to trade what I see, not what I think. And what I see is the following. So far, we have a very basic 5-wave Elliott trend ongoing the S&P. We're looking at a daily chart, the S&P 500 cash. And from the June 2013 low, I see a first wave, second wave, third wave, fourth wave, and what I believe to be a possible wave 5 high. Okay, Elliott Wave, okay, really is very similar to classic Dow theory, which you guys should all know. This is pretty much Charles Dow is the grandfather of technical analysis, and he points out that there's 3 phases of a market trend. 1, okay, is accumulation. 2 is widespread participation, and number 3 is DIST, distribution. Okay, that's the same thing as saying first wave, here's your second wave, which is your correction, wave 3, wave 4, which is your second correction right here, followed by wave 5 up. Okay, and one of the cardinal rules here, guys, is in a good Elliott trend, you should not get overlap between wave 4 and wave 2. That level's at 1710. If that happens, this wave count is not correct. Our stop loss needs to be in place, and we're wrong in the trade. Okay, so to further refine where we could be into this trade, which is a long entry, okay, we can pinpoint it with Fibonacci levels. Fib and Elliott Wave go hand in hand, okay, just like peanut butter and jelly, baby. All right, so we've done 2 Fibonacci price studies to find out where the end of wave 4 is. First one is a 50% price retracement of wave 4. Second one is a relationship between wave 2 and wave 4. Okay, so those 2 fib levels are saying we should end somewhere between 1736 and 1717. Remember, 1710 is WCI, wave count validation. Okay, we also, using fib time analysis, we have an idea of when wave 4 should end. Okay, so if you would look at, okay, kind of this time zone from here, which is, I believe, January 28th, out to the outer Fibonacci level, which is February 13th. Okay, we have a time zone. We also have a price zone. This is the lower Fibonacci price. Here's the upper Fibonacci price. So together, guys, we have a nice little zone of where this wave 4 should end. Okay, best news is, guys, all we have to do is risk just below 1710, right down here. Just give it a couple points, stop loss like 1708 stop. Okay, and if we're right, we should get a 5-wave move up towards about 1900. Okay, so you're talking about possibly making 150 points to risk what? Maybe 40. Okay, so that's how you do a high reward, low risk scenario. Strategically speaking, tactically speaking, how would we do it? Personally, I love to do this with options. Okay, wave 4s can last a little bit longer in time than you expect. So what I like to do is maybe take advantage to sell some pumped up volatility. You could sell some put credit spreads a little bit lower, sell some out of the money puts, however you want. If you're a little bit more bullish, you could do like a vertical call spread, okay? Buy like an at the money 1750, sell something a little bit higher, okay? We're not looking for the S&P to go to 2,000 right away. Just looking for a little wave 5 move up to about 1950. All right, guys, so we have a plan. Okay, we know what we're going to expect. We know how we're going to trade it. We're not going to move into this trade emotionally and make stupid mistakes. Okay, we have created a very favorable risk-to-reward scenario with a good quality wave count. Trend is on our side, and we're setting ourselves aside from the crowd. That is how you plan your trade your plan. All right, guys, best of luck.